Trump just made a bold statement. The market is going to skyrocket. Now is the time to buy stocks. But is it really? Are we on the verge of a historic rally or brutal crash? In this video, you'll find out what's really behind Trump's words, the hidden risks, and whether this is actually the best time to invest or the worst. Like, share, and subscribe so you don't miss any upcoming videos with deep insights on money, investing, and financial freedom. Trump's statement about the stock market. Recently, Donald Trump made a comment that caught the attention of investors around the world. If I win, the market will skyrocket. Buy stocks now. This isn't the first time he's used this kind of language. In the past, Trump has made bold economic predictions, and sometimes he was right. One striking example happened during his presidency. About a month after he said, "The economy is about to explode," he announced a suspension of trade tariffs with China. The market jumped nearly 10% in a single day, creating a wave of optimism for investors who caught the rebound. These comments aren't just political talk. They actually influence market behavior. A single powerful phrase can move billions in minutes. When a former president and possible future one says stocks will rise, a lot of people start buying. But is this a smart strategy or a setup? It's essential to look beyond the headline and understand the full picture. The current state of the market. Right now, the market is at a turning point, and everyone's watching one key date, July 8th. This could be a major shift for the global economy, depending on the decisions that are made. That's when a 90-day pause on trade tariffs ends. During this break, markets stayed relatively stable, but uncertainty about what's coming next has caused anxiety and speculation. Investors are on edge. Will the government tighten restrictions or ease them? Market performance will depend heavily on that answer. And uncertainty is the most dangerous element for any portfolio. There are two possible outcomes. Higher tariffs. This could trigger panic, especially among short-term investors. The result might be a sharp drop in stock prices, especially for companies that rely heavily on imports or exports. Lower tariffs or new deals. In this case, the market could rally as investors believe the worst is over. And as we've seen before, positive trade news can quickly drive up the S&P 500 and other major indexes. It's like a high-stakes poker game between governments and investors, and everyone's betting big. Being able to read the signs could be the difference between gaining and losing a fortune. Trade tariffs and political decisions. Tariffs are at the heart of this conversation. They directly affect prices, inflation, and the overall pace of economic growth. And, of course, investor sentiment too. Recently, Trump mentioned the possibility of applying 80% tariffs, which, interestingly, would actually be lower than the current 145% on some foreign goods. This suggests there may be room for flexibility, and perhaps even negotiation. This potential reduction shows that Trump might be aiming for a more strategic approach rather than an aggressive one. He knows that a falling market could undermine his message of economic success. But the final decision isn't up to him, at least not yet. It's in the hands of Treasury Secretary Scott Bent, who has taken a more technical and cautious stance. Scott is seen as more analytical and less impulsive. His decision could balance protecting the national economy with the negative global impact of high tariffs. Another important point is the ongoing rumors of new trade deals, especially with European and Asian countries. If these deals come through, the effects could be twofold: easing inflation and boosting export-oriented stocks. Smart trade negotiations can rebuild market confidence. And when confidence returns, so does capital, especially from large investment funds. The role of interest rates and the Federal Reserve. Meanwhile, the U.S. Federal Reserve has another major concern: the benchmark interest rate, the federal funds rate. This is one of the most powerful tools for managing the economy. It affects almost everything, from personal loans and mortgages to credit card rates. When it rises, borrowing gets more expensive and spending slows. When it drops, spending tends to increase, which can boost the economy but also lead to inflation. Interest rates also have a big impact on stock prices. Higher rates make fixed income investments more attractive, pulling money away from the stock market. Right now, Fed Chair Jerome Powell has made it clear there won't be rate cuts anytime soon. inflation is still a real threat. This shows that the Fed is more focused on controlling prices than on encouraging immediate growth. Stability is a priority, which may frustrate investors hoping for quick relief. In other words, even if the market is looking for stimulus to go up, the Fed isn't ready to support that, at least not yet. This tug-of-war between growth and control could hold back stock gains in the short term. The risk of stagflation. There's one scenario that scares economists the most: stagflation. A nightmare for governments, companies, and investors alike. Stagflation is a dangerous mix of high inflation, weak economic growth, and rising unemployment. It's like trying to drive a car with an overheated engine and flat tires. Historically, it's rare, but when it happens, the damage is serious. That's what the U.S. went through in the 1970s, and the effects lasted nearly a decade. And what could lead us there? High tariffs and high interest rates. Exactly what we're seeing now. That combination can shrink consumer spending, raise prices, and stall investments. If the government sticks with tariffs and the Fed keeps interest rates high, we could see rising prices, falling consumption, companies cutting jobs. That's the worst-case scenario for unprepared investors. So, if you're thinking about following Trump's advice and buying stocks now, you need to understand the full context. It's not just about reacting to a catchy quote. It's about understanding how the system works. A clash of visions. Trump versus the federal things get even more intense when you look at the direct conflict between Donald Trump and Jerome Powell. They represent two very different views on how to manage the U.S. economy. Trump has been openly pressuring the Fed to cut interest rates. He claims inflation is under control and that the country needs a boost to grow. In one of his most controversial remarks, he said, "Jerome Powell is a fool. He's wrecking our economy with this absurd policy." That statement drew heavy criticism from economists and analysts around the world. But for Trump's audience, it was seen as a sign of strength and leadership. On the other side, Powell has remained calm and technical, stating that inflationary pressure is still significant, especially in energy, food, and housing. This clash creates more uncertainty for the markets. Who's right? And more importantly, who will win? Investors need to know how to navigate when two major figures are pulling in opposite directions. If Trump returns to power and manages to influence the Fed, we could see major shifts in economic policy. But until then, caution is key. Guidance for investors. With all this going on, what should you do with your money? That's the million-dollar question. First, figure out what kind of investor you are. Trader, looking for quick profits, reacts fast to news, but is also more vulnerable to emotional decisions. Long-term investor, focus on years, not days. Use a strategy, discipline, and invest regularly regardless of the headlines. If you fall into the second category, the most reliable approach is still the ABB strategy. Always be buying. That means invest every month, even when the market is down. Focus on broad indexes like the S&P 500 or ETFs representing diversified sectors. Take advantage of dips to buy quality assets at a discount, like a clearance sale on valuable stocks. Remember, time in the market usually beats trying to time the market, and consistency is a long-term investor's true superpower. Complementary strategies. For more experienced investors, or those willing to study a bit more, there's another approach: spotting market shifts. This strategy is about watching where the money is flowing. For example, if tariffs hit import-heavy companies, local producers might gain value. If rates stay high, banks and financials might profit more from lending. If new trade deals are signed, exporters could benefit. The key here is analysis. Keep an eye on metrics like trading volume, fund flows, and reports from major asset managers. This can reveal where big money is moving and help you follow the smart money. These moves won't usually show up in the mainstream news, but if you pay close attention to the data, you can spot trends early and get ahead of the curve. Trump might say the market will take off like a rocket, but as you've seen, there's a lot more behind that statement. Tariffs, interest rates, political decisions, and leadership conflicts can create both opportunities and traps. The key is having a clear strategy, knowing your investor profile, and staying focused on the long run. If this video helped you better understand the current risks and opportunities, comment and share it with anyone who wants to invest wisely. And remember, the market always rewards those who study more and speculate less. Your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth-building strategies.